Hey guys, what's up? This is Tony from alphapursuits.com. In this video, we are going to talk about how to manage losing trades for the wheel strategy. Stay tuned. This information is for informational purposes only. Please do your own due diligence before placing any trades. So the reason we want to talk about the wheel strategy is because that is the primary strategy that I use to trade options. But a lot of the things that we're going to talk about also apply to other types of strategies as well. So the first thing we want to do is to define when we plan to get out based on price and time frame. Now this can be done by doing technical analysis and fundamental analysis. So later on in the video, I will show you a couple of examples. But what I want to do is to talk about two different scenarios. So first scenario is when a stock is undervalued. So in that first scenario, we want to basically wait for the stock price to go up. So obviously if we sell put, which is the first part of the strategy, the wheel strategy, we obviously want to let it get assigned, or we may want to roll it out to collect more premium and wait a little bit longer to sort of see what will happen. And obviously, after we get assigned, we own the stock, what we want to do is to sell cover call. And if the price shoots up beyond the strike point of the call that we sold, now, again, this is why we want to predetermine when we want to get out. So if we already know the price right now is already beyond the price point that we want to get out, we can just let it get assigned. And if not, we just roll it out and wait until it reaches to the price point that we want to get out. So you can see by predefining when we want to get out, even the position that becomes a losing trade, we already know what to do in this first scenario. And the second scenario would be, let's say we are trading the wheel strategy because of high implied volatility. And the reason implied volatility goes up is a lot of time based on an event. So it could be an earning event, it could be some kind of product launching or some kind of result, coming out. And so after the event, a lot of the time, in fact, most of the time, implied volatility will decrease. And so if we are trading solely because of the implied volatility, not because of we are thinking the underlying is undervalued or any other fundamental reason, then we should just get out once the implied volatility drops, even if it's a losing trade. So sometimes the price of the stock could drop down beyond the break-even point. But at that point, we should just close the trade and get out. So that's why I have this label here, undervalued and IV play. So IV play means implied volatility trading based on implied volatility. Then the next point is define market conditions. So what I mean by that is we really want to look out and see what is happening in the entire market. So we should check different indicators, and one of the indicators that I use is VIX. So VIX measures the volatility, so the nervousness of the market. And obviously if it spikes up, just like the most recent large event, that would be COVID-19 happening, and we could see the VIX spike up quite substantially from one day to the other. So once we see that huge spike, what we should do is we should just close out everything and step on the sideline rather than contemplating, which one I should save, which one I shouldn't. We should just get out, close out everything, unless you have a different kind of plan in place, of course. Then the next one is to follow money management. And what I mean by that is to only risk certain percentage of your entire account per trade. So if you have a small account, ideally you should look for a cheaper underlying rather than trying to trade high price stock, especially the ones that everybody talks about. The reason for that is because you can only open one position, and if that goes against you, then you lose everything. So what we want to do is to really minimize the chance of losing everything, as well as allowing us to stay calm. Because if we already know the maximum we can lose is only 5%, let's say, of your entire account, you are not likely going to just panic when the trade goes against you. So that's what I mean by follow money management. And the last one here on the list is to understand your win-lose rate. So ideally, you should be tracking your win-lose ratio of the strategy that you're trading. What it does is it helps you think logically. So let me show you what I mean by that. So here is one of the blog posts that I posted on my website, alphapursuits.com. And as you can see in this particular table, I recorded the trades that was done up to that point of the year. So this was a March report. So the first 3 months of the year, I traded, so it's 186 trades in total for single. So that's for the wheel strategy. And as you can see, the win rate is 94%. So based on that, it's basically I'm losing one time out of 10 and winning 9 times, roughly. And so when something is going against me, based on this data and based on what I have done up till that point, I can be pretty calm about it, unless, of course, if the market is collapsing, then I would need to think differently. But if it's just one stock, based on just one stock data, then I really don't need to worry about it if the position is in a losing trade situation. Okay, so let's move on to Thinkorswim, and let me show you a couple of examples on how I do technical analysis and fundamental analysis. So for this example, we are going to use TAK. As you can see on the weekly chart, I have already drawn some lines to see where the support and resistance lines are. And based on that, I have predetermined which strike that I want to get in. And moving on to the daily chart, as you can see, one of the line is around $16. So let's say I decide to open a $16 strike. Looking at the history of the stock price, I can see when COVID-19 just happened, it dropped down to around $12. So that sort of sets a pretty nice stock price target right there, even beyond this $16 support and resistance line. So I know the worst case scenario, if something like COVID-19 happens again, then it will most likely drop down to 12. And also this support and resistance line seems to be pretty strong right there, even though it went down a little bit lower. So I already know what sort of range that is going to move in the worst case scenario. I already know, based on the fundamental analysis, this stock is underpriced. And so I'm very comfortable in terms of letting it go below $16. I'm not going to freak out. So for fundamental analysis, I use seekingalpha.com and finbiz.com. Now, looking at some of the recent news, there was a downgrade by JP Morgan. So most likely that caused the stock price to drop recently. But looking at some of these articles, they are pretty positive, and especially the latest one is talking about how many molecules or how many potential drugs that are in the pipeline. So apparently there are about 40 of them. And looking at other values, so there's the sales and book per share. So this number looks pretty crazy. So I'm guessing that's probably in Japanese yen. and 100 yen is approximately $1. So I would say, the book per share price is around $14, assuming that's what it is, which is pretty close to what it is. So looking at all this, they all indicates the company seems to be undervalued, considering there was a recent jump there, and some of these articles are saying the revenue will likely to increase to double in the next 10 years. So again, that sort of solidifies my thinking that the company is undervalued. So I'm going to use CV AIM for the high implied volatility scenario. So the longer term weekly chart, as we can see right here, it's not performing very well. The price has been declining, and then recently it spiked up. And let's move on to the daily chart so we can see exactly what's going on right now. So we can see the stock price spike and then came back down and then it spiked again. So this stock is going really crazy, and that's why it has a really high implied volatility. So let's take a look at the option chains. I have done the fundamental analysis, but there is nothing really helpful there. So this is why I'm not even going to bother going over to a different tool to show you the fundamental analysis portion of it. So let's jump onto the option chains. So looking at the option chains, and as you can see, I already have a position open for this one. When I open it, I managed to sell it at around 58 cents, which is clearly more than 10% return of investment. So mouse over here, looking at this, here's the implied volatility. So you can see it's 355%. That is really, really high. So this is definitely a good implied volatility trade. Now let's come back to the chart and just quickly see exactly which point I would get out if I do get assigned, or if it's getting close to assignment. So looking at the daily chart here, we can see right now it's at $20-something. And I have a short support and resistance line drawn here. And then I have a longer line here. So obviously, in this instance, I'm using the longer line as the support and resistance line. And you can see it's $11, even that longer term support and resistance line. So this is a pretty nice implied volatility trade, because the stock would need to go down way below, even going through this resistance line, and go close to the $5 strike that I sold in order for me to get out. So I already know once it gets down to this line, then I will start worrying about it. But until then, I will just leave it. So that's one example of how to trade high implied volatility situation. That's it for this video. If you like the video, please give it a thumb up, follow the channel, and I'll see you in the next video.